Hey, Dustin Tibbetts, financial advisor here with Jazz Wealth Managers. How you doing today? This is our FinTips series where we just go over something really briefly to cover something new and something that can help you, and then we get out of your way, let you go enjoy your life, but having learned something new. Well, today I want to give you some do's and don'ts for retirement investing. These are good ones. Don't skip ahead. There's going to be good ones for you. And if you like what you see, maybe you'll hit the subscribe button or check us out here at jazzwealth.com. The first do/don't is I want you to think long-term. Don't think short-term. That sounds simple, but let's geek out a little bit with you here for a second. What's the average return of the S&P 500? Go back the entire lifespan, 1928 till now. What's the average return of the S&P 500? You can't disagree with me. The raw return is 9.8%. There's no opinion in there. That is the actual fact. Now, a lot of people will say 7% is the average return because they like to back out for inflation. You can't expect to make almost 10% average per year and not account for the devaluation of the dollar. So a lot of people do that, and they'll say, well, the average return is more like 7% net. Okay, how often will I make 7%? Did you know that you will actually only earn 7% in a given year less than 7% of the time? 6.7% to be exact. What does that tell you? If you're thinking in the short term going, hey Dustin, why didn't I see 7%, 8%, 9% returns? You're not supposed to. Actually, the studies, every single data point says you won't. But over the long run, you will. So if you think long term, that'll stop you from making some silly decisions in the short term. You want to know another thing? We actually did a video on this, the S&P return distribution, so you can see about how often certain returns take place. Not about, but exactly. Over 21% of the time, will you lose more than 10% in a year? The S&P 500 will fall over 10%, 21% of the time. So something you want to know for sure, because if you're thinking you're going to see something and you don't, you're either going to place blame or think that you're doing something wrong. And the truth is, you're probably not doing anything wrong. So do think long term, don't think short term, and that's a few data points for you to make sure you know why. Number two, I want you to change your deposit amounts, not your positions, not your portfolio, when you either get scared or excited. Here's the thing. I love timing deposits. I don't like timing investments. What do I mean by that? I get misunderstood here. When the markets fall, it's natural to get nervous or excited. If you think that's a discount, add a little more to your account, right? If you think that the markets falling are a reason to pull your investments out, that's timing your investments. Don't do that, right? So on the way down, especially in November, December, the stock market fell pretty hard actually in December, and $44 billion of retail investors actually sold out of mutual funds. You know what people were doing? They were selling thinking, ooh, I'm scared, I'm going to sell now, sit on the sidelines, and when things start to look better, I'll put my money back. What happened? You got ripped off, right? Because you panicked and you sold in December. So far, all through the month of January, what did we do? We recovered almost 9% of everything that was lost in December. Almost recovered all of December. So now what's happened? You're sitting on the sidelines, you're waiting to invest again, and the market's leaving you in the dust. And you're fearful you're going to miss out. So I want you to consider adjusting your deposits. Do not pluck and put investments in your portfolio. Time the deposits, don't time the investments. You'll have a lot of fun with that. I do. When the markets fall, I like to up contributions, tell customers of ours, hey, you might want to up your contributions now to buy cheaper. We'll get it put to work. When the markets recover, you have more of something that other people won't have more of. Okay, number three, I want you to diversify by product, and I want you to diversify by strategy. Don't just diversify. You know how people tell you, hey, diversify, diversify, diversify. Well, when you physically sit down at the computer, where's the diversify button? Like, what does that actually mean? Well, Dave Ramsey's a big one where he'll say invest in different types of mutual funds. Well, what he's telling you to do is diversify by strategy, diversify by international, diversify overall by growth stocks, growth in income. What he's telling you to do is diversify by strategy. That's just another way to say it. Something else you can do is diversify by product. You may have mutual funds, maybe there's some stocks that you like in there, you might have some ETFs, exchange traded funds. That would be diversifying by product. So I want you to consider diversification by product and strategy. Don't just buy a whole bunch of stuff and say, I'm diversified, I got everything I need. Number four, I want you to don't actively manage a passive account. That's essentially the same thing that I said in point number 1, is don't be short-term when your goal is long-term. So what happens here is when the markets fell in December, people get active with their account. If you have 30 years, 20 years, 10 years left till retirement, you are actively managing what's supposed to be a passive account. You will get into trouble with that. I see it all the time. I mean, it's not my opinion. I just watch people do it, and then I try to teach them through it, and sometimes you can't. Number 5, the last thing I'll give you here is I want you to learn about your investments. Don't just set it and forget it. While the investments themselves will do what they need to do, I want you to learn, right? You're here because you wanted to learn anyways, so I want you to continue with that. At Jazz Wealth here, what we do, we have something called the Dojo, which is just a fun way of having a little video library with tons of education not available here publicly that teaches our customers, right? That helps them understand what to kind of go through. That S&P distributions video, if you go back a week from this video, you'll actually see it there. I shared that with you guys. That's what we share with our customers. So you get like a little sneak peek of what's going on there. But I want you to learn. Doesn't have to be a lot. We've been 6 minutes into this thing, and you've already learned a few new things. So be sure to check out our other videos if you would. And if we helped you, hit the subscribe button. But that's all I have for you. No more sales pitch. We'll see you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.